Hello everyone, my name is Akshat Tibrewal and I work for Jitendra Tax Consultant. Welcome to today's session on transfer pricing and its compliance. Transfer pricing is a crucial concept for multinational companies and tax authorities alike. It refers to the prices at which transaction occurs between the related parties in the multinational group. Understanding how transfer pricing works and ensuring compliance with relevant laws is crucial in managing tax compliances, liabilities, and avoiding legal penalties. In this session, we will explore what transfer pricing is, why it matters, how it is regulated globally, and the key compliance requirements that companies must adhere to. Our very first topic is what is transfer pricing. Transfer pricing refers to the prices charged for goods or services or intellectual properties transferred between related parties within multinational enterprises. These transactions could involve sale of goods or services between subsidiaries of the same parent company, licensing of intellectual properties or patents, management fees or royalties paid between affiliated entities, intercompany financing arrangement like loan or guarantee. Because these transactions takes place between entities that are not independent, the prices at which they are set can affect how much tax is paid in different jurisdictions. Essentially, transfer pricing allows companies to allocate profits between various subsidiaries and jurisdictions, which can have a significant impact on their overall tax burden. Why transfer pricing is important? Transfer pricing plays a crucial role in how multinational companies manage their global tax positions. Some of the reasons why transfer pricing is important include tax minimization. Multinational corporations may use transfer pricing strategies to shift profits from high tax jurisdictions to low tax jurisdictions, minimizing their overall tax liability. Compliance risk. Tax authorities around the world are scrutinizing transfer pricing to ensure that companies are not engaged in above practices like profit shifting or tax avoidance. Corporate transparency and accountability. Proper transfer pricing ensures that companies pay taxes in their jurisdictions where economic activities occur, maintaining fairness and transparency in their tax system. The next concept is arm's length principle. One of the most important concepts in transfer pricing is arm's length principle. This principle states that the prices charged between the related parties should be same as if the transaction occurred between independent unrelated parties. In other words, transactions between affiliated companies should reflect the market price that would have been agreed upon in an open competitive market. The arm's length principle is the basis for determining whether transfer pricing are appropriate and compliant with the laws. If prices deviates from what would have been in the open market, tax authorities may challenge the transfer pricing and adjust the taxable income of the entities involved. For example, if one subsidiary of multinational company sells goods to another subsidiary at a significantly lower price than what similar independent companies would charge, the authorities may consider to be at non-arm's length pricing, leading to a tax adjustment. The next concept is transfer pricing methods. There are several methods that multinational companies can use to determine whether their transfer pricing is at arm's length. The most common methods used includes comparable uncontrolled price method, resale price method, cost plus method, profit split method, transactional net margin method, or any other method as prescribed by the government. Global transfer pricing regulation and compliance. Transfer pricing regulations vary by country, but most countries follow the guidelines set by the OECD. The OECD provides a framework for transfer pricing compliance, including OECD Transfer Pricing Guidelines. These guidelines help companies apply the arm's length principle and establish the correct pricing methodology. They are adopted by over 40 countries and provide a uniform approach to transfer pricing. Local tax laws. In addition to OECD guidelines, each country has its own transfer pricing rules. These local rules and regulations may have specific requirements regarding documentation, pricing methods, and reporting. This is a global standard set by the OECD to require multinational groups to report financial and tax-related information on a country-by-country basis. The goal is to increase transparency and provide tax authorities with a clear picture of how companies allocate profits and taxes across jurisdictions. Common challenges in transfer pricing compliance. Complexity in documentation. The process of preparing transfer pricing documentation can be complex and time-consuming, especially for multinational groups with intricate structures and transactions. Differences in local regulations. Countries may have different transfer pricing rules which can lead to inconsistencies or double taxations. Companies must navigate these regulations carefully to ensure compliance in all tax jurisdictions. Benchmarking and comparability issues. Finding reliable and comparable data for benchmarking transfer pricing can be challenging, especially when dealing with unique products or services. In conclusion, transfer pricing is a crucial aspect of tax compliance for multinational companies. Understanding the arm's length principle, the various methods for determining transfer prices, and the regulatory environment is essential for maintaining compliances and avoiding tax penalties. Companies must also ensure proper documentation and adhere to local and international guidelines to mitigate the risk of tax audits and adjustments. Thank you for joining today's session on transfer pricing and its compliance. It is important to stay informed about the issues to navigate the complexities of global taxation successfully and ensure that your company remains compliant with the law.